Welcome to Module 14. This is our last chapter for the entire semester. So we got a few weird taxes and credits to get through here towards the end, and then we are done. So let's talk about a couple special taxes. We're going to review the self-employment tax, and we're going to look at the alternative minimum tax. So self-employment taxes are what is levied against an independent contractor. And recall a few modules ago we talked about the difference between an employee and an independent contractor. And of course, one of the differences is that the self-employed are required to pay both halves of their employment taxes. Recall that Social Security is 6.2%. That's times 2 for both halves, or 12.4. Medicare is 1.45% times 2 for both halves, 2.9. And self-employed have the same cap on wages, or in this case income, for Social Security, which is 128.4 in 2018. So John pays his employee Stephen $120,000. So John ends up paying the employer's share of 7.65 times $120,000. That's $9,180. And of course, John also takes a deduction for these taxes, right? So his after-tax cost is $91.80, and I'm assuming John is a corporation times, the 1 minus the tax rate of 21%. So his after-tax cost is $72.52. Stephen pays the other half, 7.65 times 120. Of course, the individual gets no deduction. So if Colbert is instead self-employed and generates $120,000 of net profits from his Schedule C business, Colbert pays both halves, 15.3 times $120,000, that's $18,360. But the self-employed deserves the same sort of deduction that John deserved when he paid those taxes. So the way that works out is the first thing you do is you take a 7.65% haircut from net profits. So rather than paying 15.3 on the full 120, instead you take the 120 multiplied by 0.9235, which is of course 100% minus 7.65%. You get 110,820. The 110,820 is now what you multiply by the 15.3%. So Colbert, as a self-employed individual, his self-employment taxes are $16,995. So if Colbert earns a profit in 2018 of $146,000, then we would take the $146,000 multiplied by 92.35%. We get $134,831. Note that that is over the Social Security cap. So as a result, Social Security, the 12.4%, is paid only on the first 128.4, whereas Medicare is, of course, levied against the entire profit after the haircut of 134,831. Multiply that by 2.9%. And you get Colbert's self-employment taxes. Okay, so the next item we're going to deal with is the alternative minimum tax. So the AMT is designed to, in air quotes, take back the advantages provided in the tax code from taxpayers who manage to get too much, and too much is also in air quotes, too much benefit from those advantages. So it's an entirely new supplemental tax system in which we're going to recalculate taxable income, except we're going to call it alternative minimum taxable income. And we're going to use different rules. And for the most part, those rules reduce the amount or the number of deductions you can take. And then tax is recomputed using a new set of schedules. So here is, in summary, what the AMT calculation looks like. So you start with taxable income. You have any AMT adjustments and tax preferences that you add or subtract. That gives you AMTI. Oh my, I like to think of it as AMTI before the exemption, because the next step is you calculate an AMT exemption, and then you get the amount of AMT that's actually subject to the tax rates. Multiply that by the tax rates, you get the tentative minimum tax. You compare that tax to the regular tax. And only if the tentative minimum tax is greater do you pay it. And that is called your AMT. So what are the common things you're forced to add back for AMT purposes? Well, you're not allowed to take the standard deduction. You're not allowed to deduct your taxes if they were an itemized deduction. However, note that other itemized deductions are permitted for AMT purposes. We talked about incentive stock options. Remember that incentive stock option income is not recognized for regular tax purposes. It is, however, included as part of your alternative minimum taxable income. And then there are differences in depreciation, and we didn't dig in too deep on that in this class, so we're not going to dig in too deep in total. So the Form 6251 is what you use to compute your alternative minimum tax. And if you look, it says, enter the amount from Form 1040, line 10. Recall that that is the income prior to the standard deduction. And then what you do is start adding stuff back, right? So, for example, line 2A. If filing Schedule A, enter taxes from line 7. So that's the tax deduction. If you don't get to deduct the taxes, then of course you don't have to include any refunds in income. That's on line 2B. And then there are a series of other things that are different. Net operating loss deduction. You have to calculate a different NOL for AMT purposes. Line I, exercise of ISOs. You'll see that's the add back. And then there are some other minor differences that tend to be pretty uncommon, except for the highest income taxpayers. So you combine all that together and you get AMTI, right? So that is before the exemption. The next thing you do is calculate the AMT exemption. So think of the exemption as being some set amount, some set deduction that all taxpayers get in an effort to reduce the number of taxpayers that would have to pay AMT. So the exemption amount for married filing jointly is $109,400. For single head of household, it's $70,300. For married filing separately, it's $54,700. So what happens is you get that exemption up until you hit some certain amount of AMTI. And currently, the married filing jointly threshold, where the phase out begins, is $1 million. So you can see that you'd have to make quite a bit of income before you're going to have to pay AMT these days. That is new. That is a function of the Tax Cuts and Jobs Act that started in 2018. So the exemption and phase outs are both indexed for inflation, so they'll change in 2019, 2020, et cetera, et cetera. But note that these increased amounts, like a lot of the individual items, are set to expire after 2025. And the AMT has two tax brackets. It is progressive, but there are only two of them. So the tax rates are 26% and 28%. And it's 26% for the first $191,100, and then 28% for everything above that. So Homer and Marge have AMT income before the exemption of $1.1 million. Let's see if we can calculate their exemption amount and the AMTI that would be subject to the alternative minimum tax. So recall that the exemption starts its phase out at $1 million. So at $1.1 million, we're $100,000 over that. The AMT is phased out for a quarter for every dollar over the threshold. So we multiply the $100,000 by 25%, we get $25,000. We phase out the exemption amount of $109,400 by the $25,000. The exemption amount is $84,400. As a result, the amount of income that would be subject to AMT would be the $1.1 million of AMTI before the exemption, minus the phased out exemption amount of $84,400 leaves $1,015,600. All right, let's take it to the next step. Let's assume Homer and Marge have taxable income of $800,000 and AMT income before the exemption of $1.1 million. What is their regular tax TMT and AMT? So we would calculate the amount subject to AMT just like we did on the previous slide. That's $1,015,600. So we know that the first 191.1 is taxed at 26%. So we get that amount. And then the additional amount above 191.1 or 824.5 is taxed at 28%. Add those two together, the tentative minimum tax is $280,546. We can calculate the regular tax using the married filing joint schedules, and we'd see that their regular tax on $800,000 of income is $235,379. As a result, the tentative minimum tax exceeds regular tax. Therefore, Homer and Marge have AMT of $45,167. Okay, so after we're done calculating tax, next comes tax credits. And we're going to talk about a number of these tax credits. So the child and other dependent credit, to be differentiated from the child and dependent care credit, the adoption credit, a couple of educational credits, the American Opportunities Tax Credit and the Lifetime Learning Credit, the premium tax credit, and the earned income tax credit. So recall that credits are different than deductions. They are a dollar for dollar reduction in tax liability. So if we were to take a taxpayer that had no deduction and $10,000 of income, and we assume, a 10% rate because they're in the lowest bracket, the tax would be $1,000. If they were permitted a $3,000 deduction against that income, their tax would be lowered to $700, and therefore they would save $300 on tax. So that makes sense. You take the $3,000 times the 10% marginal tax rate, there's your $300 worth of tax savings. If, on the other hand, you're a high income taxpayer, so now a high income taxpayer at 37% would pay $3,700 in taxes. But note that the high income taxpayer that takes the deduction for $3,000 gets a much bigger reduction in tax. It goes from $3,700 to $2,590. That's much more than $300. In fact, it's 300 times 37%. So a deduction results in an uneven playing field. What that means is the higher your tax rate, the more valuable a deduction is. And we can contrast that with a credit. So let's say we get a $3,000 credit for a low-income taxpayer. Well, they can deduct all $3,000 against their tax, and as a result, get a $3,000 benefit. And if it's a refundable credit, they even get some money back. And even when they're a high tax taxpayer, the same $3,000 is taken. So the benefit for a credit is the same between high income and low income taxpayers. All right, so where do we take these credits? You should have some familiarity now with these forms, but this is page 2 of the 1040. You can see on line 12A, the child tax credit or the credit for other dependents is recorded there. You can see that there's a Schedule 3 that contains a number of other non-refundable credits. And then down on line 17 are some refundable credits. For example, the earned income credit. Under 17B, the refundable portion of the child tax credit. And under line 17C, the refundable portion of education credits. So here are the non-refundable credits listed on Schedule 3. So the foreign tax credit, the credit for child and dependent care expenses, those education credits we've mentioned. There's a savers credit for very low income individuals that actually put money aside for savings. They can take a credit for a percentage of what they put aside. The residential energy credit, and then there are a couple other credits that are less important. So let's talk about first the child tax credit. We've talked about it previously. We'll talk about it again here for a second. So this is a credit for taxpayers with children. There's a credit for each child under the age of 17 and, of course, claimed as a dependent. In order to be claimed as a dependent, they would need to meet the definition of a qualifying child. And there are two parts to the child tax credit, a non-refundable part and a refundable part. So let's start in 2018. The credit is $2,000 per child. We know that it starts to phase out at $400,000 for married filing joint income (AGI), and $200,000 for all other taxpayers. These thresholds are increased substantially over the previous ones, and this one phases out for $1,000. Phases out $50 for every $1,000 you're over the threshold, or part thereof $1,000 that you're over the threshold. The refundable amount of the child tax credit is the lesser of the amount of the credit that was limited by the amount of tax liability you had, or 15% of earned income over $2,500, but limited to $1,400 per child. All that is limited to $1,400 per child. Okay, so there's no form required for taking the non-refundable child tax credit. You just fill out line, I think it's 12B. You use Form 8812 to do the additional child tax credit, and I think you can count on us doing an in-class exercise that includes that this week. If the non-refundable credit is limited by tax liability and you have to have earned income of over $2,500, in order to get a refundable share, or you can have 3+ kids. Each child claim must have a taxpayer identification number by the due date of the return, which means that you can't get one after the fact and file an amended return. And if a taxpayer erroneously claims a child tax credit due to reckless or intentional disregard, then they lose their ability to claim that child tax credit for 2 years. And if it's fraudulent, it can be more than 2 years. So tax preparers are required to complete a form that's a due diligence checklist to make sure that they've taken all the steps necessary to confirm that the taxpayer is eligible for the child tax credit. And these days, refunds for the child tax credit, the refundable part, they're being held. What happened is in the first year they released it, a whole bunch of people filed refundable child tax credits right away that they did not deserve. And so the IRS implemented a strategy of delaying refunds that are associated with tax returns that have a refundable child tax credit claimed. So Fiona and Chris Everest are married and file a joint return. They have one child, age 13, and each member of the Everest family has their Social Security number, and their 2018 AGI is $409,800. Holy cow, I'm having a hard time speaking. The maximum child credit is $2,000 per child. However, the Everest AGI exceeds the $400,000 threshold. So we need to calculate the phase-out amount. So we take 409,1 minus 400,000. That's 9,100. 9,100 divided by 1,000 is 9.1, but we always round up for this phase out. So 9.1 actually rounds to 10. 10, not $10, but 10 times $50 is $500. As a result, they are required to phase out $500 of their child tax credit. And so it goes from $2,000 down to $1,500. Bob and Michelle are married filing joint taxpayers, have 2 qualifying children, AGI of $72,000, and that's all earned income. And their tax liability before any credits is only $1,043. So their child tax credit would normally be $2,000 per child or $4,000, but it's going to be limited by their tax liability of $1,043. So Bob and Michelle can claim the refundable portion of the child tax credit of $2,800 or the lesser of, so first the unclaimed child tax credit. Well, they could have taken $4,000. They were limited to $1,043, so that's $2,957. Or 15% of their earned income less $2,500. So we take their earned income of $72,000, subtract $2,500, multiply by 15%, we get $10,425. Note that all of this was limited to $1,400 per qualifying child, which is $2,800. So they're going to claim an additional refundable child tax credit of $2,800. The other dependent credit is only $500. So say, for example, you have a child, but they're over the age of 17, or 17 or older, I should say, then they would not be eligible to take the child tax credit, but they could take the other dependent credit. So let's assume Alex is a single taxpayer with a 15-year-old child, and Alex takes care of her elderly mother, who also qualifies as a dependent. So Alex would be eligible for $2,000 of child tax credit for the daughter, and an additional $500 under the other dependent credit for her mother, who is also a dependent. So our next credit is the Child and Dependent Care Credit. And this credit is designed to give tax relief to working parents who have to provide child care for dependents. So the dependent must be under the age of 13 or a spouse or dependent who cannot care for themselves. So if the child's parents are divorced, the child need not be a dependent of the taxpayer claiming the credit if he or she lives more than 50% of the year with that parent. Multiple qualifying care costs your qualifying care costs by an applicable percentage based on the taxpayer's AGI in order to quantify or calculate the credit. So the applicable percentage is anywhere from 35% down to 20%. And those percentages are right on Form 2441, which is the form on which you claim the Child and Dependent Care Credit. So I'm not showing lines 1 and 2. Those are basically informational lines where you're supposed to list who the child care provider was, who the dependent was, etc., etc. And you take from that the amount you paid to those qualified providers. And note that line 3 says don't enter more than $3,000 for one qualifying person or $6,000 for 2 or more. So the absolute most you can claim, no matter how many dependents you have, greater than 1, is $6,000. If you have 1, the most you can treat as qualifying expenses is $3,000. So you compare that to your earned income in line 4. If you're married filing joint, you compare it to your spouse's earned income, because the idea is if one of you isn't earning any income, then you should be home taking care of the child from a tax perspective. You then enter the smallest of those. So think of it as you enter the smallest of 3 or 6,000, or your actual expenditures, your earned income, or your spouse's earned income. And then what you do is enter your AGI. That's Form 1040, line 7. And based on that amount, calculate what is the applicable percentage you're going to apply to your child and dependent care costs. So for example, if you made AGI of $50,000, the maximum amount of credit you could apply is 20%, because the decimal amount for everything above $43,000 is 0.2. So what are qualifying expenses? That includes in-home and out-of-home care. Day camps qualify, but not overnight camps. And the camp must be focused on fun and games and not education. The amount you can credit is limited to the lesser of the earned income of the lowest earning spouse, which we know, or $3,000 for one dependent, or $6,000 for 2 or more dependents. And it must include the taxpayer ID number of a caregiver. So note that if a spouse is a full-time student, you can count the time they're a full-time student as them earning $250 a month for one dependent or $500 a month for 2 dependents. So that way, if one of the spouses is going back to school, they can still claim this credit. So Joanne has salary of $58,400, investment income of $2,100. Lure's spouse is a full-time student for 12 months of the year. They have 3 children under 13 and total daycare costs of $12,800. And what we need to do is calculate their child and dependent care credit. So we start with her earned income or his earned income, which is $6,000. And we were imputing that at $500 per month because, of course, the husband was a full-time student. Okay, so we end up with the lower of those 3 amounts, her earned income, his earned income, or the amount they actually paid, which would be limited to $6,000 anyway. Then we would look at AGI. AGI is well in excess of $43,000. So we take the $6,000, multiply by 20%, and voila, we get a $1,200 child and dependent care credit. So our next credit is the adoption credit. I don't want to spend a lot of time on this other than to say this from a policy perspective was trying to balance out the fact that typically you can have a child and insurance pays for it. Whereas when you adopt a child, typically you get no reimbursement. So to provide a tax incentive for adoptions, there's an adoption credit. That credit is the amount spent up to $13,810 per adoption. And it begins to phase out when AGI in 2018 is over 207,140. And there are different rules if the adoption takes more than 1 year, it's a foreign adoption, or the child has special needs. Okay, let's shift over to education credits, something that I think most students can appreciate. We'll start with the American Opportunities Tax Credit, which provides tax relief for qualified higher education expenses. You complete a Form 8863. Again, I have a feeling we're going to be doing that. It's available for each eligible student. And an eligible student could be the taxpayer, it could be the taxpayer's spouse if married filing jointly, or it could be a taxpayer's dependent. It only qualifies in the first 4 years of college. And eligibility includes the following requirements. You must be pursuing a degree or some recognized credential. You must be attending at least half-time for 1 term during the tax year. And you should make sure that you have a Form 1098-T from the higher education institution because you're required to record information from that form onto your American Opportunities Tax Credit. So the credit is the 100% of the first $2,000 and then 25% of the next $2,000 spent on qualifying higher education expenses. So the maximum credit is $2,500. It begins to phase out when your AGI exceeds certain levels, and page 635 is not the right page. 40% of the American Opportunities Tax Credit can be refundable. And again, if you're a tax preparer, you must complete the due diligence checklist, which is Form 8867. So the lifetime learning credit is a little bit different because it's a more broad credit. So tax relief for education expenses and encourages taxpayers to take courses to acquire or improve job skills. So you can only include the amount of tuition and fees, not your books. It can be used if you are less than a half-time student. But the credit is and the credit is not subject to a felony drug offense prohibition. So that means you could have been convicted of a felony drug offense and still take the lifetime learning credit. This credit is also reported on Form 8863, same as the lifetime learning credit. So the lifetime learning credit is 20% of the first $10,000, which means the maximum credit is $2,000 a year. It has a much lower AGI phase out than does the American Opportunities Credit. And you may take credit in relation to undergraduate, graduate, or professional courses. And there's no limit to the number of years you may claim a lifetime learning credit. So for each student, a taxpayer can generally only get one of those credits. But you could take an LLC for one student, one dependent, and the American Opportunities Tax Credit for a different dependent. Only the person claiming the dependency exemption can claim a credit. And you cannot claim one for sports, games, and hobbies unless the course is part of a dual program. And of course, to the extent you are reimbursed any of these expenses by a tax-free scholarship or employer, you must reduce the amount you're trying to claim against the credit. So Dave and Val are married filing joint. They have 2 dependent children, have AGI of 72,000. Sean's taking 4 credits, so he's a part-time student at City College of Newark. His tuition and fees are $4,200. Corey is a freshman at Tulane. Her tuition and fees are $39,200. Neither of these children have a felony drug conviction. So what is the amounts that Dave and Val can claim as education credits on the tax return? So Val and Dave are going to be able to take $33.40 in total education credits. So we need to figure out how that is the case. So first, Sean may not take the American Opportunities Tax Credit because he is not enrolled half-time. As a result, he takes 20% of the $4,200 he spent. That's $840 of lifetime learning credit. Corey, as a freshman, however, qualifies for the American Opportunities Tax Credit. So we know she's going to qualify for 100% of the first $2,000 and 25% of the next $2,000 or $2,500. Recall that her tuition was well in excess of that at $39,200. Okay, so Corey Val and Dave are going to claim a $2,500 American Opportunities Tax Credit for Corey, and we are done. Okay, so now the premium tax credit. So we're not going to spend a lot of time on this other than I want you to understand what it is. So under the Affordable Care Act, eligible taxpayers can receive a tax credit that is intended to lower the cost of their health care. To be eligible, the taxpayer must meet all of the following requirements. So first, health insurance is purchased through one of the state exchanges or the federal exchange. 2, the taxpayer is not eligible for coverage through an employer or government plan, because obviously if you are eligible for coverage, you're not eligible to receive a credit against what you have to pay. The taxpayer's income must fall below certain limits. We'll talk about what those are. The taxpayer is not permitted to file married filing separately except under very limited conditions. And the taxpayer cannot be claimed as a dependent by a different taxpayer. Okay, so how low is low enough? Well, you compare the income to the federal poverty level. So a contribution amount is calculated based on how close to the federal poverty level your income is. That's compared to an average plan cost. The difference is a credit that the taxpayer is eligible for. Either they can sign up to receive it in advance, so as each month goes by, or they can elect to receive it at the end, in which case then there's just a true-up. So there is a refundable, So that's it for the premium tax credit. Now the earned income tax credit, which is a refundable credit, which means this serves as a negative income tax. So a lot of the very needy will get earned income tax credit. It could be 100% refundable, and they get to keep it all. Taxpayers with children can receive an earned income credit. And actually, a taxpayer without a child can too, but the income has to be very, very low. So if the taxpayers are married filing separate, they can't take the EIC. Everyone must have a valid Social Security number. Earned income must meet certain types of guidelines. And disqualified income, which is primarily investment income, must be less than $34.50 in 2018. So each child, like these others credits we've seen, must have a taxpayer ID by the due date of the return, so April 15. If the taxpayer makes a mistake and claims it, it loses it for 2 years. If the IRS rejects the earned income credit for any reason other than an error, then you have to file a form to get in the good graces again to receive it. And again, it has the same sort of delay on refunds and also a checklist for any tax preparers that are completing the earned income tax credit. All right. That brings us to the end of the video lecture for Chapter 14. We're going to have a fun in-class exercise where we'll do ProConnect one more time and see how these credits get calculated. Thanks for watching.